All right, so I'm a Zoomer, and I advise mainly boomers on how to retire. That's my profession. It's kind of weird. Um, the age gap is strange sometimes, but we're not so different, you and I. Um, our generation names rhyme. People in both of our age groups really like to protest, and we all like Steely Dan and we all like Dire Straits. Um, So, what I'm going to do here to start this segment of Not Your Financial Advisor is we're going to watch some Zoomer humor. My dad seemed to really like this. He'll be in some videos, by the way. He's 63, and when I showed this to him way back, this is something. This video is something even kids younger than me wouldn't find funny. It's out of date, but this was 2018, I think, when this came out, and he thought this was hilarious, which shocked me. So let's just jump into it. We've all been here, watching that chart, sweating, place the order.
Yes,
Bogdanov, Isenik,
Ibort,
Iwento Olin.
Dump it.
This has happened. You're lying if you're saying this hasn't happened to you. If you're in your late 50s, early 60s, and you're telling me that hasn't happened to you, that it hasn't felt like there's some little gremlin living in your Robinhood account or your Fidelity account, waiting for you to make a buy or sell order, and then making the exact opposite happen in the world, you're lying, because that's happened to all of us. And today I want to talk about emotional investing, which is a topic that's been milked, but you can never have too much milk, is what I say. I don't think you can talk about this enough. So we're doing two videos today. One was that joke. Let me know if you think that was funny. If you are a boomer, and I'm not saying that as a pejorative. If you are a baby boomer, let me know if you understood that or thought it was funny, or if it utterly confused you. Uh, Again, I was shocked when my dad followed along and I didn't have to explain it to him. So now we're going to watch, I just saw the thumbnail of this, Bahaj Finserv Mutual Fund. And they have 2 likes. Somebody come on here and show them some love. The reason we're watching this is because the title and in the thumbnail, the speaker has better hair than I do. So, yeah, emotional investing, that counts as panic buying or selling. We're going to talk a little bit about that. And that also, I want to touch on the phenomena of whatever you do, the market does the opposite of. But let's jump into this video and I'll talk about it as the thoughts come to me.
How to avoid emotional investing. Investing in mutual funds or the stock market,
Sorry, had
you've
a
probably
interruption there.
experienced
Back to
moments
it.
where emotions influenced your decisions. Whether it's fear during market crashes
We might
or
need some captions on
excitement
this.
during a rally, emotional investing can sometimes lead to poor outcomes.
Yeah,
Today,
that's true.
let's talk about
Let me tell you, I haven't heard anybody so far in my life. I haven't come across anybody in my personal life or a client or a prospect who came in to visit us here for a consultation. I've never heard anybody say, wow, I made a decision purely based on panic or ecstasy, and oh boy, I'm so glad I made that decision. I'm so glad I made that impulse buy. I'm so glad that I panic sold. I'm so glad that you don't hear it, because we might, despite the fact that we might be able to nitpick our decision making through the course of our whole life, and maybe that panic decision was good. Maybe you asked a girl out when you were nervous and she said yes. That's always possible. But for the big decisions, for the life-changing financial decisions, I have yet to meet somebody who was happy in hindsight with their quick decision. You got to think about it. Ask yourself, do you know anybody who told you that, man, if it wasn't for me freaking out and losing my composure, I would have never had the fortune I've accrued. It just doesn't happen. So, yeah, poor outcomes, that is a massive understatement, but let's keep going.
How you can avoid emotional investing and stay on track with your investment goals. What is emotional investing? First,
Please explain.
let's quickly define what emotional investing is. It happens when your decisions in the stock market or mutual funds are driven by emotions like fear, greed, or excitement rather than by logic and strategy. For example,
Here's the thing, and I'm going to say this probably in every video. We, as much as we like to think we are, because that's the default, go try to find somebody who will proudly claim irrationality, who will say, I am not a reasonable person. You're hard-pressed to come across somebody who will admit their shortcoming in the reason department. But the fact is, we are extremely unreasonable, irrational creatures. There's that saying, it's been quoted to death, the market will stay irrational longer than you'll stay solvent. That's because at the core we are irrational actors in our lives. You have to be able to come to grips with that to get around it. Otherwise, you're relying on pure luck. And a lot of things are pure luck. Even the things you plan out the most, when you dot your I's and cross your T's, a lot of things still come down to luck. But if you plan, you can at least steer that luck around potentially. I used to give talks, and I would always tell people that those who fail to plan to fail, and I will die on that hill. You can't convince me otherwise, because I've seen too many things go the other way. You can't take credit for luck, is what I'm trying to say.
when markets are crashing, fear might make you want to sell everything. Or when the market is soaring, greed might make you want to buy at the peak, hoping for.
This is something I've thought about from my experience investing individual stocks, not investing on behalf of clients, is, okay, so if I'm going to go buy a stock, if I'm going to go do anything, it's very reliable in my experience that the exact opposite will end up happening. With that in mind, what I've experimented with, and it's too hard to do this all the time, but what I've experimented with is doing the opposite of whatever my first impulse is. If you're one of those people, you know who you are, because I'm one too. If you're one of those people where you buy a stock and it tanks, or you sell a stock and it shoots right back up, maybe if that happens all the time, you should just, whatever you want to do the opposite of it. Just try it out. That's not financial advice. Don't start with money. Start with smaller, more manageable things. If you're talking to a loved one and they always get mad when you bring up a certain topic, even if as innocuous as it is, maybe just do the opposite or don't bring it up. Just there's little things in life you can tweak minimally that can make a compounding difference just in your behavior.
Even higher returns. Both of these reactions can be harmful in the long run. Why emotional investing is dangerous? Emotional investing can lead to buying high and selling low. This
Yeah.
is one of the most common mistakes. When the market is
I
booming,
might have already touched on this. If I have, I will edit this out. I had an interruption and had to stop the recording for a second. But the level we are at as probably mid-range IQ investors who work other jobs and aren't full-time investors, the level of literacy, financial literacy we're at is utterly predictable to hedge funds and big asset managers. So they already know the pattern. They know what we're going to do as non-institutional investors when they're looking at a chart. I'm not saying they literally look at like a Thinkorswim chart, but if they're looking at a candlestick chart, they can tell you where average people are going to lose. They can tell in a pump and dump that the institutional buyers are going to be in the pump and regular people like us are going to be in the dump. That's almost a science. If marketing works on you, if you ever see a movie poster or a burger advertisement at a restaurant or something, and you go buy that thing, and you can tell that you are a person that responds to advertisements, then you're not immune to this, and it happens to all of us. To more or less of a degree, we can catch these little subconscious things, but yeah. So there's two ways to get around this. There's two ways to get around the fact that the odds are stacked out of your favor as an individual stock picker if you're going out there picking your own stocks. You can either, on the high end, this is the less attainable end, you can be so smart you know every variable and you can minimize risk. You can't eliminate it, but you can minimize it to the most efficient level. That's too hard to do. Just take that one off the table. Or you could know so little and be so unpredictable because you have no pattern recognition in financial markets that you might accidentally end up doing what an institutional buyer or a hedge fund will do. But if you're somebody who you keep up with Morningstar, you're at the gym on the treadmill in the morning, you're watching CNBC, you're watching Mad Money. If you're somebody who has a cursory knowledge of this stuff, and you consume financial news outside of your 9 to 5, you don't know enough. You know just enough to make very bad decisions that are very predictable to people that know more than you. So it's a tough spot. This can be mitigated. The two ways being super smart, not knowing anything, or you can plan. You can pre-plan before you make any decision.
You might feel pressurized to invest, and when the market falls, you might panic and sell. This can lock in losses and hurt your long-term returns. Chasing quick gains. Emotional investors often get swayed by
Never chase. Not with money, not with crushes, not with I don't know. Don't chase. That's just 101. Would you ever tell someone you were responsible for to chase an investment, to chase after chase after rejection? And I'm not saying give up. I'm not talking about a lack of persistence here. You know what I mean. Let's get back to the point. That wasn't a great tangent.
short-term market movements, trying to capitalize on them, which can result in missing out on more stable long-term growth opportunities.
I want to mention the selling out. And what did he say? Let me go back real quick. Oh, paying attention to very short market movements, and it's such a bad thing to do, to watch the market all day if you don't have to. Like, we have to. If we didn't have to watch the market all day, I wouldn't, because so many crazy thoughts will occur to you during a Fed meeting, or like I always say, if the president tweets or something. So many potential actions come up when you start freaking out, knowing that something's happening that's going to shake the markets. You'll just ruin you'll blow your lead. You're going to take out all the steam that you should be saving for the long haul. A good example of this is there was a lady who came in here who, from another country, started working here in the 80s. Company got a 401k. She didn't know anything about 401ks. And her coworker said, "Hey, come here, I understand it. Let me put you in a couple of things." This is in the 80s or maybe the 90s even. Anyways, all the time until this year goes by, she comes into our office. She didn't know how to get into her 401k. She didn't have the PIN. She didn't know the balance. She didn't know what she was invested in. But when she finally got in, after the 2-hour phone call with Fidelity, She had $2 million in there, and it was all Amazon. Now, the choice was luck. The selection of stock was luck, but what she had unintentionally done was set a very good plan in motion without even knowing it, which was just to ignore things and occasionally check in to make sure that it's not on fire. That's the safest thing you can probably do. Now, you have to make a good initial decision. I would more recommend picking an S&P index or something like that. But I don't know. Watching the markets every day, keeping up at lunch and checking it every second you can, it's like scratching at a scab. It's never going to heal, and it's going to leave a scar. But if you just forget about it, you look up one day and, oh, my skin's beautiful again. So,
Praying from your plan. If your emotions are guiding your investment decisions, you're less likely to follow a sound long-term strategy. This could mean abandoning your investment plan just when you need it the most. How to avoid emotional investing.
So I think I'm going to end it here. I'm pretty sure he's just going to go back over everything in reverse and tell you general advice on how to avoid selling, like, in a panic. But yeah, emotional investing is a horrific thing. When you feel like you're buying and selling at the wrong time, it's one, because you're probably not being as logical as you thought. That's okay. I do that too. You just have to plan around it. And two, this isn't really a point made. Well, this is a point in the first video, the meme, the joke video. There are bigger fish in the pond that know how little fish like us think, and you're not going to get one over on them. So that's kind of the takeaway. There are ways around it. Planning, strategizing. I'll leave you with this. You should always know before you get into a position in a stock or in any kind of investment, you should know when you're going to get out and when you're going to get out if it goes down, and when you're going to take profits if it goes up, assuming you're not doing a full long-term leave it for 40-year strategy. Pre-plan your entries and exits, and then you'll at least know what you can lose. You can do that for free. Now, we offer that at our firm. We have stop losses built into our portfolios that we manage. That's a 2% fee. You might argue is high, but no one does it themselves. And I'm not saying you have to get that. It's very likely that's not a good fit. My point is, just whatever you're going into, whatever engagement you're about to get into, have a plan. That's the big thing. Have some kind of plan, and you'll do better than people that have a semi-plan, or they plan and then change it up. In my life, 95% of my plans, I could confidently say, have worked out from point A to point B. But the route that I had charted to get from the starting point to the end goal has almost never been what I had in mind. And you have to expect that going into investing, and you have to be aware of that, so that when you stray off course a little bit and you have a 20-year time horizon, you don't freak out and go so far off course that you don't end up at the end goal. You want to get to where you're going. So thank you for watching. This has been kind of a rambly video, but this format is rambly, and I appreciate you being here. If you have any questions, if you have any concerns, let me know in the comments. I would love to make videos. If you have questions that you want answered and I have the ability to answer them, I'd love to take a crack at it. So you take care. Go drop this man a like. Go drop Bahaj. Show him some love. That's what the goal. That's one of the goals here, is these two channels. This guy doesn't need it. But take care, and I will see you in the next video.